Hello and good morning, listeners. We start another week with Almus Market Mornings, and this is Shikhar Garg. We've had a lot of data releases in the past few days, and changes by the central bank actions have been accordingly. But we have ECB, who's coming up with their next dilemma of having a hike of a quarter percentage point or a half percentage point hike, while most of the central banks have opted for a pause in the current session. Now, to rationalize this hiking cycle has been way more aggressive than any other we have seen in the last 2 3 decades. So that's quite interesting to watch out how would ECB choose its path. But on the other hand, oil has held its gain comfortably over the last couple of weeks, uh, and the FX reserves in India has also seen some sort of building up. Now we've had the highest jump in the last 9 months, approximately 6.3 billion, which looks like as our central bank doesn't want to miss out on an opportunity to replenish some bit of the reserves exhausted. What do you think, JK, about this?
Good morning, Shikhar. To start with India, I think the reserves have gone up also more because of revaluation of foreign currency assets. We have had a big move in the euro and other currencies, and these assets, obviously, the central bank has also been diversifying into other currency assets, which have added to the rise in forex reserve values. Also, the gold, which has had a very good rally of around 15% in the last few weeks, also added to the reserves value. So all in all, I think the intervention from RBI was probably far less than what we had seen in earlier months. So I'm putting it down more to revaluation. Interestingly, we did have trade data also from India, which was published on Thursday ahead of schedule, and the trade deficit has gone up by 2.5%. Increase in imports was on a month-on-month basis more than the exports, which was the cause for the deficit to rise to over nearly 20 billion. And then even the net surplus from the services side was lower on a month-on-month basis. That contributed to the deficit. Overall, of course, the picture is not looking as bad as it was about 3 4 months back, and the projections for the current account deficit is now held at around 1.2%, which is quite comfortable. Now, the biggest question for rupee, how much influence it can take from these developments, is how do we get and how much inflows do we get, because the global credit conditions are tightening, rates are higher, and there is some fear about the recession globally. So whether global investors are in a mood to put a lot of money into the EM markets right now, because all having said that, we have been seeing a lower deficit, we still need funding to you know bridge these gaps, and so the important thing would be how whether we get and the outlook on this is definitely uncertain. Therefore, I think in the slightly larger picture, we still do not have a case for a big strength in the INR. We did have some move lower in USD towards 81.60 on Thursday, but that got reversed after the dollar index itself moved about 1%, which means that there's no big selling that's coming at lower levels. So for this week, I think we will have the range between 81.60 and 82.40. That should cover the market for now, until we get bigger clues on the flows and what the RBI policy is on with regard to the forex. On the global markets, of course, it was indeed a week that threw mixed picture on the US economy, ending with mostly positive data on Friday. News and inflation was definitely good. CPI holding, rather CPI headline falling more than expected, although core remains sticky. PPI had a lower than expected number across, and what was following was the retail sales that was not as bad as expected, with a big rise in January actually making up for a good quarterly outcome. And the retail control, which strips out the volatile components, was in fact better. Industrial production was expanding in March. Michigan survey showed consumer sentiment actually improving. And to top it all, the inflation expectations for 1 year rose by almost 1% from 3.6 to 4.6. So for investors who were for long discounting a slowing economy and inflation, there was no further news to back up their negative view, and what resulted was a sell-off in the bonds and a rebound in the dollar on Friday. In fact, 2-year yield has been rising for the last 3 days as much as 23 basis points. The dollar sellers could not ignore this rise in the yields, and the short covering was a logical result. That has seen the DXY rise more than 1%. The technical picture, of course, shows a bullish engulfing pattern on the dailies, a double bottom at 100.80 and a weekly positive divergence for the dollar index. And I will not be surprised to see a move above 103 in the coming session, probably in the run up to the FOMC and also the ECB meeting, which is to follow immediately thereafter. Adding to the bullish moves in yields and the dollar were statements from 3 Fed members. Mr. Waller and Mr. Bostic actually sounding quite hawkish about next hike in May. In fact, the market itself has been seeing a higher probability at 81% that Fed has to hike in May, although there is some discounting of rate cuts later in the year. I think that will largely depend upon how the economy evolves. Only soothing thing for the markets was a statement by Ellen, who said that the banking crisis is leading to some credit conditions tightening, and that may actually do the job for the Fed in the coming months. So indirectly, she means that there may not be too many rate hikes going forward. So I think there is almost a consensus that beyond May, rate hikes is almost very low probability. But there are some private analysts who think that market is still underestimating the rate hike possibilities. But I think we need to wait and see how. Important thing to note is the oil prices, which have gone up 15% in the last 2 weeks, and this will probably have a telling effect on the headline inflation in the coming months. Therefore, one should not get too complacent on the headline inflation. So let's wait and see how these things pan out. OPEC's report, of course, also stated that the demand could be slowing down as far as oil is concerned. So that might be behind their decision to cut the output, early last week. All in all, we are looking for some kind of second-tier data this week, not so much important, but the focus will slowly shift to the run-up to the FOMC as well as the ECB meeting, and before that we have the Bank of Japan meeting, with now markets almost like not assuming a change. That's how the market seems to be behaving, because the various statements from the new setup in the BOJ is making leaving no opportunity to stress on the fact that they will continue with the easing policy. So all in all, markets await for more clues, and possibly we are in for some consolidation period for the dollar and the yields. Thank you.
Okay, JK, that was quite good. And I really like the point wherein there needs to be no complacency on the headline CPI numbers, and oil as an indicator has also given up enough reasoning for the same with a 15% rise. But what's quite interesting to listen is the possible underestimation of the hike probability, or the market expectations of a hike have been on the lower side. That needs to be seen whether how the Fed and the ECB and the Bank of Japan actually think about acting on. But on the domestic side, folks, yes, as JK mentioned, the trade data was a bit on the wider side after 3 to 4 months of reduction, but it was not it isn't as bad as it was a few months ago. So yes, although we've seen net surpluses from the services side, on the lower side it's still a bit reasonable side. And the fact that JK mentioned the jump in FX reserves is not only because of the currency revaluation, but it is also because of the gold move, and it's not to be attributed only to the interventions by the central bank. That's it for today, folks. We shall come back again tomorrow with another round of updates. Thank you so much for listening.